Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll go through the market update, and I think Shawn's going to go through a little bit more of the search criteria. And obviously we're open to questions. We've had really good dialogue the last month or so. So there's lots to talk about in the market. So feel free to unmute yourselves and chime in at any point. So thank you. Let's get started. Okay, overall, same states for everything from last week. No real changes there. We had the green pie kind of shrink a little bit. I think it was up 38, 39. So we've been creeping back there. So let's look at market pulse. I'm on bullish bearish here. So you can see we, last Tuesday, right around 36, 37, got up to close to 40, and we started turning back. Hard to say, if that's going to be the ongoing trend here, but we did have a nice spike, new lows from yesterday, it was at 652. So that's not insignificant. It's a pretty big spike for one day. We'll have to see if there's follow through. We did a lot of that analysis in the past, off that initial spike, there were, residual spikes, sometimes bigger, in the coming 3 months from after that. So, that's kind of the forward expectation is, retest the lows, which are fairly close as far as SPX right now. So that's what to look for there. Let's look at the state 1 and state 8. So the 1 and 8s, it's kind of same story. Didn't, started looking like from up here that it was going to try and get at least to a cross point. But last week, pretty much right after our meeting, it stopped, and now it's turned. So both are now working away from each other. So it's kind of same story there. Looks like it's trying to push higher with the red states, globally, and with state 8 specifically. So just keep your eye on that. Obviously when from Sadir, when the green pie is growing, it's usually a good bullish market for trades. So right now it's been shrinking. Let's look at the modeling for SPX. So, I think, kind of some of the point out here is, the stop losses. These are really good, support and resistance levels when you look at them. Got up above, tested here, ran up again. And this is where basically this point up here was that 50-day SMA that we've been talking about as resistance now since it flipped. So it tried twice to get over that 50-day, and then broke through this resistance level here, and then it turned. Well, this was support at that point. After it tested it, flipped over, and now it's resistance. It tested here, and then we had a pretty good fall off, and I think we're down a little bit today. So, I think the modeling, it's really important just to watch these key levels, the stop loss levels, and, the target levels. So obviously not a typical move for state 4, where we'd kind of go like this, kind of like that, but still very useful information, from the modeling here. Let's look at the big chart. So I already threw up the Fibonacci. So it kind of compounds that. But that top line is the 50-day SMA, and then the bottom line is the 200. So right now we're below that 200. Let me kind of zoom in here. So what I was talking about before on that previous state forward chart for SPX was the 50-day SMA getting in that neighborhood, and pretty much failed right away. We had talked about for months and months how this 50-day was really great support. So now once it broke through that 200, basically went up and tried it again. Now that becomes resistance. So that's our key level for SPX on the upside for resistance. If we want to try and make new highs, last week it was 4,600. Now it's 4580. So that's a big longer term resistance. Kind of near term would be this 200, which we're below. Obviously, a bearish sign that we're below both of those. So that's at 4460, call it. One of the other things I wanted to pull up, we did this a few months ago, looking at kind of long-term monthly charts. Use Yahoo Finance because we don't have them in our system yet. But I wanted to show you some of the key metrics here. So a couple of months ago, we were looking at the IWM, and basically the MACD on the monthly basis was about to cross over, and then we had a big down swoop. So right now, SPY, I just pulled up the SPY, same as SPX, just the ETF version. So if you look at the numbers on the left, we're pretty close to like a crossover. And when IWM did that, it had a big swoop down. So you can see, if we kind of look back, when it does, it's riding above. And this is the Keltner channel here that I have. When it's riding above and it does break down, it usually gets down to that kind of middle, the middle band, which is the 30-day EMA. Usually it'll at least hit that. So that band right now is 380. So that pretty much correlate on this chart to, this is called 3,800 ballpark. So that pretty much matches up perfectly with the Fibonacci from the Corona low. That's 61.8. That line right there, if we kind of zoom in on it, it's pretty much like 3,800. So those things are kind of lining up for if we do break this key level that we've been at, and it's been tested quite a bit for SPY, which is that Fibonacci 78.6. You can see here 1, 2, 3, and we're on the fourth test of that. So if we do break below that, hold below that, the next bottom, as far as what I see, would be that the next bottom level would be 3,800 range for SPX. I don't know if Joe wanted to comment. I'm not a Fibonacci expert, but it seemed pretty logical, going this longer term and seeing how it's been supported on that initial Fibonacci line. If we break below that, you can see that would be the next, which coincidentally lines up right with this kind of Keltner channel, when you're running above it. And you can go back over time in it. When we have these, we've been running above this channel since, what is that, August of 2020, pretty much, one dip below. But typically you're in the range or slightly above it, but it's been such a drastic move, well above those Keltners. So right now we're pretty much right at the top end of it. Usually when it does break, it'll hit the middle line, which is the EMA, the 30-day EMA on that. So a lot of things lining up. as far as kind of that like next level, if we do break below, which based off of this, this MACD, this is basically telling me, it's a force of nature at this point that we're going lower. I can pull up quickly the cues on this. It's already crossed. As of, so January, we're slightly above, and now February, we're below. You can see the pretty big movements after the cross. IWM, we crossed a while ago. So this was December, January. So I think we talked about this around January. You can see the big moves down, and it's pretty much going right down to that 30-day Keltner middle channel, which is the EMA. So it's pretty much almost on that. So I think the IWM is kind of paving the way, not to be a bearer of bad news, but this chart right here just looks like gravity's pulling this thing down. So one thing you can think of is you want to do some kind of cheap like hedging bet. You could always basically a couple months out, put like a iron butterfly at the 380 kind of range. You can probably get it pretty cheap, and if it does get down there, it'd be a pretty good payoff risk reward type thing. So just something to think about. We can go into that more if people have questions. Let's look at Russell real quick.
Yeah, Josh.
Yep.
It's Jean.
Hey, Jane.
I would like to hear about the iron butterfly being a couple of months out whenever you have time.
Okay, yeah, I'll go into that in a second.
Okay, thank you.
Okay, so Russell's behaving fairly well in state 8. We always talk about the longer it's in there, better prospects. It's going to have a big move down typically. So obviously, the typical pattern started out pretty close to that, but it usually goes down here. So ours went up instead of down from there, but bounced right off of our resistance levels, which is stop losses. So that'll be the key area there for the Russell, that range. And we'd, if it continues down, we'd at least expect the average move 10%, which goes right in between target 2 and 3. That would be our at least expectation of minimal move is that average move. Time wise, it's at average is 32 days in there. We got 20, so that's 12 trading days, so a little under 3 weeks to go there. But so right now it's, let me clear this. Obviously this is like a secondary level of resistance, and then the entry price, if we stay below that, that would be the next resistance. And then as far as going up, and then we'd have to see if it can make new lows, which would be right below target 2. So it's already tested that, so that'll be something to look for. Can it get below that target 2 level? If it does, then you'd expect the average move at least. But obviously something to keep your eyes on, those kind of key levels as far as the Russell there. I guess the only other thing, I like to pull up Sadir's Fed tool. We kind of at least take a peek at it each week. It's moved a lot, last week, initially, this is kind of like the first week we looked at it. And then last week, is more of a 50-50, and now it's kind of going back to the 25 as far as that first meeting. I've seen a lot more expectations of, a lot more kind of hikes going forward, month after month. Like some people are predicting like 10 straight to get to like 2 something, So it's just something to keep an eye on as far as the expectations, especially as we get closer into the meeting. Then I would assume this is going to be right most of the time, because that's what the Fed's goal is, the message to the market, exactly what they're going to do before they do it. So before we go, I guess, doing that SPY thing, any questions or comments about the market?
All signals are bearish to me.
Hmm?
All signals are bearish in the market right now to me.
Yeah. Yeah, I agree. And I mean, we talk about, that initial low spike and retesting, and sorry, that was a back test. Our data says, 6 out of the 7 times it'll make new lows after that, initial big spike here. So, if we kind of look at this range 43, we're kind of in that ballpark. If you look at the actual charts, that low was like 4,200 kind of range. So that's right, basically on that support line for Fibonacci. So it's really, I think, can it hold that level for SPX? If not, we got our next low as far as the Fibonacci. So I agree, it's looking ugly geopolitically, inflation-wise, Fed-wise. I don't, earnings weren't, those earnings, if they miss, they got hammered this time. So it's a lot of bad news out there. I
I just saw a news report that U.S. warns Ukraine there will be a full-scale Russian invasion in 48 hours. So you obviously have the statistics on the back test, which also point bearish. Then we have the Fed, which points bearish. And then now, of course, the Ukraine thing is, everything to me is a bearish signal right now.
Yeah, well, I mean, oil going up, inflation, at what, 9% or something, whatever, really high, obviously. That's not good. Yeah, it's hard to find something good as far as the market, in my opinion. I agree with that.
Hey, Josh, Lee here.
Yeah, hey, Lee.
Hey, Josh, how have the studies been doing over the last month or two? Just off the top of your head. You don't have to dig it out.
Yeah,
Go through just
no.
a general feel.
Yeah, they obviously some of them are taking hits. They had such a good run going basically up until this point here. So yeah, obviously some of them, have been not kind of dragging. I mean, you're still getting some winners getting closed out, but there's quite a few open trades.
Yeah.
Yeah, so those are taking a little bit of a hit overall, but obviously, if you start them from last year, you're still up quite a significant sum, but you're taking some hits here right now, and there's still some of them still have quite a bit of expiration, but some of them will be coming due mid-March, so those could be potential losers. If what we see in the market here doesn't turn around.
Okay, thank you.
All right. Any other comments or questions about the market?
Josh, Dan here.
Yeah.
Yeah, just a comment. I think that this, we're entering into, in my opinion, a long-term bear market. I think the Ukraine, as far as, we're not going to war in Ukraine because they're not a NATO country.
Yeah.
So I think Russia's going to do what they want. We're going to just kind of stand by on the sidelines and just apply sanctions. But those sanctions, it's going to probably take place over the next couple of months, and Russia is going to feel it. And the intel I got is that they're gonna, come back at us, through, it could be, cyber warfare, things of that nature. But I think that overall, you're gonna see the energy prices soar for like oil and gas. I think that's gonna go up because someone's gonna have to try to make up the difference for Europe. Russia kind of has them over a barrel, and if they shut off the pipelines, which they're talking about, that's going to be overall bullish for oil and gas.
Yeah.
And so I don't know. It is very ugly. It's being reflected in the market right now. I mean, you get the overnight. If you look at the overnight indices, they seem to go up overnight, and then by the end of the next day, they just they finish at lows. That's kind of hard to trade as far as unless you, I don't know. I think it's probably a good market for doing defined risk, spreads and stuff like that. But yeah, I don't know. It's not looking good in my book.
Yeah, I think it's hard to know exactly what's going to come out of the whole Ukraine thing. I think Putin, he's a chess player.
Yeah.
If he's going to do what he feels he'll be able to get away with, I think. I'm not sure exactly what that is, but I think the oil, they're a big oil exporter in gas. So, I think he's using that as leverage, based off of, how upset we are about current, pump prices, much less, if they go higher. I mean, it's pretty much double from like a year ago, I think. So it's hard to say that, exactly what's going to happen there.
Yeah, I think the sanctions that we put on will cause them. China as Russia's partner now, so Russia will probably be selling their oil to China and Iran and places like that. But the other thing is, Russia also is one of the top countries in the world for selling fertilizer, and we buy a lot of fertilizer from them. We only produce 6% of the world's supply of fertilizer. So I'm just wondering, I think that'll have a tremendous impact on our agriculture over here. So that could, cause another spike in food prices,
Yeah.
just further exacerbate that inflation, and yeah, although, the way the market's looking and you have a hawkish Fed, that's ugly mix.
Yeah, I agree. I've heard about, well before this Ukraine stuff kicked up, I heard of many news stories about fertilizer shortages already prior to that. I didn't know Russia was too much involved in that, but yeah, that could definitely help drive inflation. I mean, higher prices for oil, ripple throughout the economy. I think there's thousands of products created from it, plus, the gas that people use to transport things. So that's really not helping with inflation at all. So that's a good point.
And I don't hear any talk about reopening the Keystone pipeline.
No. Oh, well, those are all good points.
Yeah.
Appreciate it. Anyone else? This is going slow here. I'm trying to pop something in there. Oh, not sure why this is slow. Apologize. I guess while that's loading, I can just pull up like an option table. So if we just kind of use that 380 number, so that's what, like almost 50 points away. And I just kind of use that 2 months from, just glancing at previous charts. Once it crosses, like within a couple months, it usually hits it. So I'd just say April. Good Lord. All right. I think my back tests were slowing things down here. I'm running big back tests in the background here. So you could do like a long put butterfly. We could do an iron butterfly. Let's look at the long put. So this is basically like an iron butterfly, but you're not using calls and puts, you're just using puts. So let's look at the, so what did I say, 380? So we're selling 2 here. And then below, let's just call it like 20. You can experiment with, 10, 20, 30, whatever. The tighter it is, the cheaper it'll be. And 400, let's just do these kind of ballparks. So, so basically you need, your max gain is when, if it expires April 14th at, 380 bucks. So this is pretty much 0. And you'll get the the max profit off of that 400 leg, and the 360 will be 0. But you're buying one here. You're buying basically the wings up above and below, and then you're selling 2 in the middle. So you can see like the risk reward, it's 100, call it 128 bucks for one of these. And then, your max profit, I mean, you're not going to get your max profit, but if the market does move down, you can realize pretty good gains. It's not going to really degrade significantly until you get closer and closer. So, so this one, it's a little bit of a time one, but it has to go in your direction. But if it does, it can pay off really well for dirt cheap money there, 128 bucks a pop. So that's kind of what I was talking about. And that's a long put butterfly. I mean, you can do similar for
Josh, I'm sorry, I missed on why you picked the 380 strike.
that was just from the charts, basically one, this next Fibonacci level down, if we break, this first level is basically 3,800. So we'll call it 380 on SPY. And then the other one was the middle of the Keltner. If it does correct, it usually goes at least to that middle of that Keltner, which is at 380. So that's, the two things basically told me the same thing, where it would, the bottom would be next, or at least the next resistance if it breaks. Does that make sense?
Okay.
So someone's calling. So, sorry, I'm gonna. All right, someone's loud. I had to mute people there. Okay, so this is the iron butterfly. So the difference is, you have your calls instead of buying 4 put. Using 4 puts, you're doing 2 puts and 2 calls. So you're still selling, a call at 380 and a put at 380. The kind of reason it shows a little better risk reward, not much, but the problem I think with this is, this way out of the money call, it might be tough to, the liquidity on that may be tough to execute. So you maybe get the same price, depending on, how those trade. I just think it's easier with the call using all the puts, but, it's kind of, it'd be interesting to see, if it does happen, just mocking both these trades and, seeing the end result. But pretty much very, very similar setup, just kind of keeps it simple using just the puts. But you could do either way. I'd just be careful on the execution of those deep in the money calls. So, if we're like 50 points away on the calls, it might be very limited activity down there. So, but the puts usually will have pretty good activity.
Okay.
Josh,
Yeah,
I have been doing a ton of butterflies. Do you mind if I make a suggestion?
no,
Yeah, go ahead.
So, I'm on the call every week. I think everybody knows I've been pretty bearish for more than 6 weeks, 8 weeks. And so I've been avoiding a lot of bullish trades, the bullish trades in the earnings plan or the bullish recommendations on the studies. But I've been doing a lot of butterflies.
Mhm.
And they're really a great hedge. And Josh, would you mind going to the options table for SPY?
Sure.
And I'll show you what I do. You can do this on any, I do it on all 4 indexes, DIA, SPY, QQQ, and IWM.
Yeah. I'll pull.
And so if you just go to, for example, let's go out, I usually just go out a few days or a week. So there's a SPY expiring on the 28th, go to the 28th.
Mhm.
Okay, so the standard deviation for the SPY is 414 on the low side. So I will put the short put at 415, let's say, okay?
Mhm.
And the long put will be right on just 1 strike out of the money. So this is frozen from last night. It's moved a little bit, but so you would sell, you would buy the long put at 429.
Mhm.
You would sell the 2 short puts at 415. That's a difference of 14 points. So then you would buy a long put at 401.
Yeah.
Right, to complete it. And then, by the way, I do these all the time. You do not want to wait for that thing to hit your middle strike price.
Yeah.
What I do is I set a target order. The thing is that the max profit is only achieved on a butterfly if it hits the middle strike price at exactly expiration.
Right.
Anytime before that, if it hits that middle strike price, because of volatility and time value, you will actually make less money, much less money.
Mhm.
So what I do is I just, I know how much I paid for the butterfly. Let's just imagine I paid $1. I'm just going to set a target closing order at $1.50 at 50%.
Yeah.
And they hit in this market, they're hitting all the time. I just had 2 hit while we've been talking. And then what I do is they hit, I had the SPY on the IWM hit, then I go out a couple more days, I place a new one.
Yeah.
Now you're showing the iron butterfly. I'm talking about just the regular butterfly. The long put butterfly.
Yeah. So what we did the first time there.
Yeah, so I just base it on the option table because that gives me a range of movement.
Mhm.
And so in this case, I would put the middle one. What did we pick? 28th, and we had 419 and 415, right?
Yeah. Well, there was no 401, so if we just do 400 and 430.
Yeah, so you balance it out. And then this costs you $2.89. So you just calculate times, 289 times 1.5, whatever that is. It's going to be, around $4. And you set a target order to close at $4, and they'll hit because the market's going down.
Mhm. Yeah, I would say, depending on your strategy, if you're short term and it gets near your strike, you close it definitely.
Yeah.
if you're longer term, then you may want to hold on a little longer, but anytime it gets close to your strike, if you're right, because the ones I showed initially were really far. So, if it got down to 380, you would want to probably sell it if it
Right.
gets to that range, or at least, sell one of, two or, something like that, so, yeah, I think the great thing about these two, longer term, if you do multiple contracts, like Shawn talks about, if it moves in your direction, well, you can pull out, one of the two and, get all your money back and just let the other one run, so these are super cheap and you can kind of lever up and, pull them off as things move down and, you obviously if they move against you, you'll still have a little bit of time. It won't kill you. But, as you get closer and closer to expiration, these will move a lot more.
Right, and I think one of the traps with the butterfly is you see the max profit and the max risk. It's such a big difference that I think people hold on to them hoping you'll hit that max profit.
Yeah, not gonna happen.
Yeah, I prefer to just do them shorter term, set the target order at 50%, let it hit, and then I'll replace that position with another butterfly just another week out. You know what I'm saying? So I just keep rolling them, and in a trending and a strong trending market, either on the upside or the downside as it is today, these work really well.
Yeah, yeah. I mean, you can't beat the risk reward out there,
Oh, that's very interesting, Samir.
And this is Shawn, and to Sahir's point, right, or even Josh, I think a lot of people get caught up by the fact that you can you hear me?
Hi, you did,
Oh.
I think you called and I.
Whoa, whoa, what's that?
That was Pushpa.
Yeah.
Oh.
That so a lot of people get caught up, not really this example, even though this is a pretty good example too, of you're risking 289 to make 1200, or some of them are even risking 100 to make 1500. So a lot of people see that 1500% potential return, but like Josh and Sahir said, it's very, very difficult, and almost 99.9% of the time you're not going to hit that exact price that you need to make that max profit on the trade. And once your break even is surpassed, then you're at max profit essentially, but you start giving back money as the stock or the ETF keeps going down further past that peak on the risk graph there. So these are great trades though, and Sahir's analysis and what he's doing is working. But I think that's great. You're getting into this like kind of like a bull put spread or a bear put spread, excuse me, and setting that profit target, getting out and getting another one as the market's kind of decreasing down, because the worst case scenario would be the market taking a huge fall really fast, and at that point in time you really can't do much with this trade, because it's just all the options are kind of increasing in value and they're really just offsetting each other.
Yeah, because if it moves huge, if it goes below 400, then you're basically on the other side of where you started. So you don't want to be there, and you start losing money. So that's kind of why you want to, it's just like the trades that we do for the vol crush trades, same
Right.
thought pattern there. Take your money and be happy. And I mean, you can, depending on how far away you are, 50% is not a lot. I mean, if you're for like those 380s, you can get hundreds of percent, if you get it right. So.
And the beauty is to use the option table to size it. People wonder, where do you put that short put? Well, you put it at the standard deviation, right? Statistically, that's where you want to put it, around there someplace.
Yeah.
So you can use the option table for that.
Yeah, that's a great idea.
Yeah.
Hey,
And then
this
I've
is really interesting because this is the first trade that I've heard about that is a bearish trade. We've always been focused on bullish. And I was wondering, Sudhir, did you back test this at all?
No, I didn't back test it. It's just an idea I came up with and it started working. And so I just do it. Like I said, I have them on the indexes all the time, and they hit every couple days, and then I roll it to the, a few more. I add a new position a few days out. I did not back test it. I think, of course, in a normally uptrending market, you'd want to go the other direction with long call butterflies. But my theory would be that uptrending markets don't move as fast as downtrending markets.
Mhm.
So then you want to go further out in time with the butterfly, right? To give
Right.
the market time. But a downtrending market goes down pretty fast. So I don't go out very far. And I would rather, just take my 50% profit and put in a new butterfly.
Sure, sure,
And then it's only a couple $100 like Josh is showing right here. So
right. So do you always take a week, expiring in a week?
yeah, a week or less, like I was showing the 28th, that's not a week, that's, under a week, right?
Yeah.
But
Generally.
yeah, around there,
Uh-huh.
Ukraine, if Ukraine, I'm sorry, if Russia goes to this full scale invasion, what do you think the market's going to do, right? They're gonna, now on the other hand, let's say Putin comes to his senses and says, okay, I'm not going to invade, the market will go up, but then I lost 289 bucks. I didn't lose a lot of money, right? If it expires worthless. So, but the odds are that the market will come down. You put in a target order. So if I'm teaching class or whatever it is you do for work and you're out, then I don't have to watch it. It'll just hit that target order. And these things
Right.
hit that 50% number very quickly if it moves in your direction. You don't have to wait for it to hit that short strike. And I'm happy with 50%. The trap with the butterfly is the people get greedy and look at the max profit,
Yeah.
and they hang in there too long.
Uh-huh.
But
All right, thank you.
Yeah, that's very interesting, Sadir. Thank you.
You're welcome.
Yeah, thanks, Adair. Invaluable comments as usual. Yeah, I would say if you're doing directional, you definitely want to do the long, either put or call butterfly, and it's really based off of the market. But, the great thing, with Delphian here, you can always test these, you can, like right now, we set it up, and you can track it in the virtual portfolio, and kind of get a little experience. Obviously, it's not exactly the same as when you have real money riding, but at least it'll kind of, if you do it over, so this is more of like trending markets where you things are going, and that the one I had was just kind of a longer term trend, and I like Sadir's idea too. Just okay, we got a downtrending market, and I think everything talked about made perfect sense. On the way down, it'll move a lot faster. On the way up, it's a slower creep usually. So, so I'll end it here for my portion. Obviously, way over time, Shawn. Sorry. I think the key
It's okay.
release is to watch this SPY level. This SPX level. If it can get below there and hold, you can see, it had real problems before, but call it 4250. We can get below there and hold, close below there and hold, our next level down is 3,800, and that could get ugly for the market. And, based off of our new lows research, it's 6 out of 7 times or something, it makes a new low. So hard to say, but, keep your eye on the Russia news, inflation, and, I think it's key level, at least near term here. So thank you all. Shawn, you're up.
Hold that chart for a second, Josh. Don't stop sharing real quick. So what I wanted to mention was back to your point, Josh, of putting these in the virtual portfolio and kind of what Sadir is saying. So, if everyone looks at the time frame of like the 27th of December on this chart, from 27th of December going down to the middle of January, and then we spike back up. Those are some pretty decent moves. I think it's like 47.50 to roughly, 42.50 in a short period of time. So what I would say is if you're wanting to look at those iron butterflies or those long put butterfly spreads, like Sudhir had mentioned, go back in time, in Delphian and map out from, the middle of December and pretend you were going to put a trade on in the virtual portfolio in the middle of December using that long put butterfly, and set the expiration out to January or to beginning of February, or how many ever days you want to do that. And you can see this little downtrend that we have going into January, point wise, is fairly similar to the point move down that we're looking at when we're looking at the Fibonacci, possibly a retracement down to 3,800. So I feel, unfortunately for everybody that's long the market right now, obviously we're losing money if we don't have any hedges on, but it's a perfect scenario in my opinion to be able to use Delphian to go and not back test, but to go in and test these strategies in the virtual portfolio, because the setup of the down move in the market, recently is really in line with what's potentially to come. And if it is, I think you can mimic, those trades in the past to possibly put those trades on, in the near term. I hope that makes sense, but I was trying to run the numbers and run the time frame, and I think you could set them up, almost perfectly to get an idea of how the trades are going to work when the market's coming down pretty quickly and how you would react. Would you do like sit here and be able to get out at that 50%, or would you want to be more aggressive and try to capture more money? And you could really, really use that for some personal analysis. Does that make sense to everyone?
Yeah, I got a question for Sudhir, please.
Yeah, go ahead. As long as Sudhir, go ahead.
Well, hey, Sudhir, what is your entry signal for these? What motivates you to enter this trade? Because I guess you look back around middle of October, everything is trending up here on the chart that we're looking at. What is your what motivates you to enter this trade?
I just got bearish on the market. I thought the Fed was tightening. I've talked about it on the call regularly. The Fed was tightening. I don't do those butterflies with calls on the way up because the market just doesn't, the daily alerts and the earnings plan and all those other trades, when the market's creeping upward work great, right? So I don't need the butterfly. But I just got really bearish on the market, particularly after my Crested Butte trip, and I saw what inflation was doing. And
Right.
Of course, the Ukraine thing escalates. So my view of the market has just turned bearish. I don't have an entry specific signal. I just felt the whole market's going down, so I don't want to take bullish trades. I'm going to just do these short-term butterflies, and they've been working. I've like 3 out of 4 are hitting the 50%. Occasionally we're getting a rally, a couple-day rally, and some expire worthless. But like I said, they don't cost very much money. So if they expire worthless, I didn't lose that much money. On the other hand, if 3 out of 4 hit their 50% target, I'm overall making money. So I don't know if that answers your question. It's just when I got bearish on the market, I just decided to do these short-term butterflies to play the market in a downward way.
Okay, thank you, Sudhir.
And then Lee, you'll hear some more about those trades from other, newsletters or different advertisements talking about those type of long call butterflies or long put butterflies. And a lot of people that I've seen will do them almost arbitrarily, right? So if they see a stock like, I just have Tesla up on another screen, so let's just say Tesla. But if they see a stock like Tesla and it's really trending around, let's say like that $800 range and you're coming into expiration, a lot of people will use a type of strategy like that, let's say on Tuesday for expiration on Friday, just with the possibility that the stock might still stay around that 800 level by Friday, right? So they'll buy either the long call butterfly or they'll buy the long put butterfly with that $800 strike kind of in the middle, assuming that it's going to stay at that range. And it's a similar setup, like Sudhir is saying, sometimes it's, $100 to risking 100 to make 1,000. But again, you got to have a stock that's going to stay, at the 800 range by, 4 days out, right? Which is pretty tough on a lot of these stocks, especially now. So you do see it a lot, but I feel a lot of times it's going to be, I hate to say arbitrary, but really an arbitrary number. You're saying, man, this thing is really just sticking around 800, and I think it's going to be there in the next 5 days. So, that analysis is pretty arbitrary in my opinion. But, the risk to reward there is huge. So a lot of people get caught up by, again, hey, I can risk 100 to make 2,000. Well, I'm going to do that all the time, right? But what's the probability of success on some of those when you're talking about a stock like Tesla, you know?
Shawn?
Yeah.
Shawn? Yeah.
Yeah, Gene.
Arbitrarily, you said 800 because is that at the money and that's why you're putting it on at that strike?
No,
that-
no, I'm just looking at Tesla and just at 800. It's at 783 right now, but
I know,
you
but
know,
I'm
some people
saying,
just, yeah.
I'm saying that Sadir mentioned that he used a one standard deviation to determine the short strike, but you're
Right.
determining at the money strike. Am I
Yeah,
hearing this right?
I was just picking a random even number, you know, 800. I wasn't really doing it for any other reason.
Oh, okay.
But you're right. I mean, Sadir
Is that a
has more of
viable?
a,
Is that a viable way to do it? For doing that long put? No.
yeah, not for what I said. I don't think. I think you're really just, you know, gambling at that particular point. I think Sadir is making more of a structured and more of an analytical and kind of fundamental analysis on what he's doing. And, you know, like Josh agreed with what Sadir said, really, you know, catching these shorter term trades like the 28th of, you know, expiration and your weekly expirations on those options, because the market does seem to drop pretty quickly, and using that standard deviation, you know, a stock or an ETF dropping, you know, one standard deviation within a short period of time in the downward market seems, you know, very viable. And then obviously with all the other analysis that, you know, Sadir's done on the market being bearish, right? I think those are picking, you know, some really good options for, you know, strike selection. Whereas, you know, some of the other things that I've seen, like on Tesla, like I mentioned, or other stocks, it's almost like they're just picking an arbitrary number. Now, you could get a little deeper and they might say, well, you know, that's where all of the open interest is on the options. So let's say you look at Tesla and the options that are expiring on Friday, you have a huge amount of open interest at the $800 strike. So then people might say, well, typically they don't want it to go there because they want these options to expire worthless or not. And so that might be where the market might try to trend, you know, prior to expiration. But again, these are just all arbitrary, you know, thoughts that people might have and a reason to do it. But I think they really get caught up in the fact that, hey, I can risk 100 to make 2,000. You know, that looks awesome, right? I mean, there's nobody can disagree with, if you did 10 of those and you just made $20,000, that's great. It's just, it typically just doesn't happen, you know?
Okay.
And,
Well,
and,
thank you.
and to Sadir's point, go ahead.
No, thank you. I was just trying to clarify. Yeah, I got you.
Yeah, and I apologize. I didn't mean to confuse you by that, but I was just kind of throwing that out there. Because I've seen those, and you know, to the average investor, you're like, man, that's an awesome risk to reward, and it is, but it just very rarely happens. And you know, if you buy a spread like that for $100, you know, and it gets to 600, I mean, are you really going to hold it until it gets to 2,000? I mean, do you have, you know, the gump to do that? Probably not. I mean, you're going to take your profit and not be too greedy, but the potential is there. But yeah,
No, I like the 50.
Yeah.
I like the 50% rule anyway.
Yeah.
Always.
Yeah, and a lot of people catch, you know, they catch your eye by doing that. So newsletters will catch your eye by saying, "Hey, I just made a 1,500% return, or I have a potential to make that," and it looks great, right? It's a great marketing tool, but just the odds are not there for it to happen all the time. And really, you're just picking it. I'm assuming they're picking it arbitrarily, where, you know, Sadir here has a lot more analysis behind, you know, what he's doing.
Yeah, remember that, you know, on the earnings trades and stuff, we have rules, right? You're gonna pick the short at a certain place, and you're gonna get out at certain percentage profit, and so on and so forth. And I like those rules.
Right.
You know, I just put in the same, but you know, I put in rules myself. You know, I use the options table for where I'm going to pick the short strike based on the standard deviation. I get out at 50%, you know, and this then it's a, you know, more disciplined approach than hoping that it pegs right at expiration
right.
at the short strike.
Yes, thank
Exactly.
you, guys. Very interesting.
And I think that's exactly right. We've talked about it many times. You know, having that plan and having that strategic structure of how you're going to actually pick the strikes and what you're going to do in the different scenarios and what you're going to do for a profit, because you can get caught up in, oh, I can make 2,000%, and it's super easy to kind of get caught up in that scenario. But, you know, taking a profit early, I mean, you're never going to lose money taking a profit early, that's for sure. So don't be scared to do that. But I just
All
feel
of-
that
all of
this
this-
setup, like,
Yeah, I'm
Go ahead.
sorry. Go ahead.
No,
No,
go
I
ahead.
was just going to make the comment. It certainly beats buying a put because they're so expensive. When you know the market's
Right.
going down or you feel like it is, it's like, oh my God, I didn't buy the put when I should have, because now it's some outrageous price, you know.
That's the whole reason to
Right.
do them. They're because you're buying some offsetting short and lower strike long, but the net effect is it's a hedge that is much cheaper than just buying a long put.
Right, right.
right.
Yeah, sounds reasonable. Yeah.
And and use the chart that Josh has up here, right? Use this chart to your advantage, because now we're in that environment again where we have a perfect setup now, and it's almost mirroring what happened in December, January, and you can really use that big fall there in January as a test case to go back in time, put those trades on, back in the first part of January, exactly the long put butterfly like we're talking about, and just run it day to day and just say, hey, what would I do here? Okay, well, now I'm out, so let me roll it into another one, using the next week's expiration, and so on. And then even on this little bounce here at the end of January, you'd get just the reverse, like Sudhir had mentioned. He's taken some losses on some of them, so at the end of January, you would see if you put some on a little bit lower, then that little bounce up, you'd be losing money, but you'd only be losing a couple $100, depending on the price of your actual spread that you bought, So I think this is a really good setup to use like a use case, if you will, to be able to see those trades work, not in real time, but to see them work like they would have if you had put them on in January. So
Yeah, great. Thanks.
if anybody does that, please let me know. I'm busy and strapped with time, but I'm going to try to replicate some of them if I can. And if I can do that, I'll share them with you, and so you guys can kind of see how those trades, progress. Because, like I said, we always talk about that, how using the virtual portfolio is a really good setup for back testing and to help you learn. And us talking about that and seeing this chart here, I think that's just the perfect example, in my opinion, to say, hey, it's really relative to what's going on now, and it just happened. So if I can replicate it and kind of show you guys how those work, I think it's a really cool tool that we have, and we can use it. So,
Hey, Shawn,
yes, sir.
I'm not the greatest back tester. I was wondering, could I get with you and we step through back testing this?
Yeah, I mean, it's like Sudhir mentioned, it's going to be a little hard to back test it, but we could get a little creative and try to figure it out. I don't know if we'll be able to back test it, but you can get with me and we can input them in the virtual portfolio and kind of see how they run in some of these downturns. We could come up with some creative entries to see when the market.
I can do that. I'm good at putting things in virtual portfolios.
No, yeah, but let's
stepping it through.
But let's get together and offline, and we can set up a Zoom, and we can just work through it and see what we come up with. I mean, that's, like I said, these calls are great for me because we get to collaborate and everybody gets to learn from each other. And doing the individual calls, I feel the same way. I learn stuff from you guys, and hopefully you learn it from me as well. And if it can make us better, in the end, that's what we're striving for. So sometimes we might not come up with the end result that we thought, but it might spark another idea, and then we can kind of move on that one as well. So yeah, let's do that.
Can I be in
Okay,
the Zoom
thanks.
class too, Lee? I mean,
Yeah,
John?
absolutely,
Yeah.
absolutely. Well, I'll get with you, Gene and Shawn, about
Okay.
a time. I'll send you an email. We'll figure out a date, time, and then we'll do it. Is that okay?
That'd be great. Thank
Sounds
you.
good. Yeah,
I'd like-
that sounds good.
I'd like to join too, Chuck.
Okay, Chuck, I'll include you.
Thank you.
Add Dan too.
Okay, hey, I'll
Right.
just send it to everybody,
Right.
and then you can, okay, thank you.
Yeah, no worries, guys.
Just reply all to the meeting, weekly meeting one, and just let everyone know when it's set.
Okay.
Yeah, that sounds
We'll
good.
do.
Yeah, we'll set it up and we'll run through it, and and go from there. So yeah, that sounds good to me. And then that's all I had. Again, I wanted to kind of replay over some stuff from last week. I just again want to remind you guys to make sure we're using, try to use the screeners. I just did an analysis briefly today. I just did a screener and looked at all the stocks that has transitioned last night into state one, and there was only, on our liquid options list, there was only 2. So I think a lot of times you can use Delphian not only to find great back tests, but then you can look in there to find some really good, for the lack of a better term, diamonds in the rough, right? There was 2 stocks on there that had transitioned into state 1, and then I wanted to look at those and see were there other option strategies that I could possibly use, to trade those 2 stocks. So really using the screener and just using the couple different tools like we showed last week that we have in there, the option screener tool to find good trades, whether you're bearish or bullish the market. You can find stocks, I think, that you want to trade, but sometimes finding those strategies that match your ideas is somewhat difficult. And that kind of goes back to exactly what we just started talking about now with those long put or long call butterflies. But using that option screener can help you find some good strategies. And you might find a trade in there that you like, you might not, but at least you have some ways to go in there and do some of that research. So I won't take up any more time. I appreciate you guys listening, and let's set that up so we can get on a Zoom and kind of run through some ideas like that as well. I think, like I said, it's a great opportunity, so let's make sure we're taking advantage of it right now. And again, thanks, guys.
Thank you. Bye-bye.
All right. Well, thank you everyone for attending. We'll do it again next week. Same time, same back place. So thank you all.
Thank you, everybody.